Welcome. My name is Jeffrey D. Smith. I am the General Manager of Starfury Capital Management. Our mission statement: syndicating private trust deed investing for financing projects for repositioning and stabilizing distressed apartments for radiant wealth creation to serve an emerging market of displaced former homeowners and new family formations. Investment opportunity. To the extent that any of the proposed transactions referred to herein would be deemed, under federal or state securities laws, to be the offer or sale of a security, be advised that the securities described herein have not been registered under the Securities Act of 1933 as amended or applicable state securities laws. The securities described herein have not been approved or disapproved by the Securities and Exchange Commission, the SEC, or any state securities commission or other regulatory authority of any jurisdiction, nor has the SEC or any such state securities commission or regulatory authority passed upon the accuracy or adequacy of the information contained herein, or the merits of the securities described herein, nor is it intended that they will. Any representation to the contrary is a criminal offense. The securities described herein, if any, may not be sold, nor may an offer to buy be accepted prior to the time an offering document describing the offering and disclosing the risks of an investment in the securities is delivered in final form. Under no circumstances shall the information contained herein constitute an offer to sell or the solicitation of an offer to buy, nor shall there be any sale of the securities in any jurisdiction in which such offer, solicitation, or sale is unlawful. Displaced former homeowners need apartments. The Great Mortgage Meltdown of 2008 displaced millions of homeowners. Adjustable rate mortgage resets are continuing to force homeowners into foreclosure. Problem: millions of displaced former homeowners suffer the indignity and stigma of foreclosure and eviction. Solution: affordable, clean, comfortable, spacious apartments provide opportunity for a fresh start with dignity. Opportunity: apartment owners overpaid and undermanaged, causing physical and managerial distress and default. Distressed properties and defaulted notes are on sale. Investment financing and yields. Access to repositioning financing. We provide access to short-term private commercial financing as debt, preferred equity, or joint venture to provide all cash offers, no seller financing or assuming notes, and fast closing. Security for our private financing is derived by first lien deed of trust with strong protective equity and cash flow margins, as determined by conservative pro forma analysis. Access to institutional refinancing. Institutional refinancing is much easier to obtain with a proven performance history and protective margins. Refinancing debt redeems all of the repositioning financing. Attractive yields. Superior cash flow margins with strong debt coverage ratio protection to tolerate recessionary pressure on income and expenses. Targeting double-digit annualized yields from 10% to 15%, with recovering the initial investment within 12 to 48 months, while retaining ownership and net positive cash flow, infinite yield, with apparent return on equity, ROE, from 10% to 12%. Tax-free cash out. Refinancing with cash out is tax-free and available for rolling into the next project. Example repositioning financing. We would provide first position debt, 70% to 90% of the investment to value, with 10% to 12% annualized interest rate. Possibly backed up with second position preferred equity with 12% to 14% annualized rate. And then third position common equity up to 10% investment to value, 0% to 18% yield. Some projects do not yield any cash flow for the common equity investors. They have to wait to get their profits from the refinance or the sale. The property is acquired and then repositioned and stabilized. After stabilization, the property is refinanced with cash out. New refinancing debt at 70% after repositioning value with a 6% annualized rate completely redeems all of the repositioning financing. Retained equity is created at 30% after repositioning value with an apparent 10% to 12% return on equity. And the common equity investors receive cash out with up to 25% annualized yield on their common equity investment. Repositioning distressed property. Financial analysis of physically and managerially distressed properties starts with the after reposition value, ARV, then calculates backwards to determine the maximum allowable offer, MAO. The MAO is also called the bid offer price. The capitalization rate, CAP, is calculated as the product of the debt coverage ratio, DCR, the annual debt constant, ADC, and the loan-to-value ratio. CAP is equal to net operating income divided by maximum allowable offer. It's also equal to debt coverage ratio times annual debt constant times loan-to-value ratio. The cap rate is equal to the NOI over the MAO. If we substitute for the DCR, net operating income over annual debt service, and then substitute for annual debt constant the annual debt service over debt present value, and then substitute for loan to value the debt present value divided by the maximum allowable offer. We then see that the annual debt service appears on top and bottom of the division, so it cancels out. We also see that debt present value appears on top and bottom of the division, so that cancels out, leaving just net operating income over maximum allowable offer. This proves the mathematical equivalency of these two equations, and therefore we can calculate different cap rates by changing the cost and structure of the financing, one of these three variables, DCR, annual debt constant, or loan-to-value ratio. Let's start with sample repositioned operating data. This is how we intend the property to end up after repositioning, with this effective gross income minus the gross operating expense, calculating the net operating income, and then dividing by the derived capitalization rate of 12.18%. We subtract 30% ARV for retained equity. This is created equity. The refinanced debt present value is 70% ARV, subtracting about 3% of the debt present value for closing costs. Calculates debt gross proceeds, from which is subtracted our future value to redeem our financing on the property, leaving net cash out proceeds, subtracting the syndicator's apportionment, leaving the equity investor's net cash out, which calculates an annualized yield of 74.52%. We are assuming that the refinanced debt has a loan-to-value of 70%, annual interest rate of 6%, debt coverage ratio of 2.25. The distressed operating data shows a higher percentage of effective gross income is dedicated to gross operating expense. The net operating income is less than the repositioned operating income. We divide by the derived capitalization rate to calculate the current property value. We calculate private debt net proceeds at 90% investment to value plus 10% equity investment from the equity investors, calculating a total investment to value of 45.35% of the after repaired value. That's a very strong protective margin. Subtracting estimated repositioning costs calculates the maximum allowable offer. And here we calculate that our private debt will deliver $840,965 to closing. We will add in an incentive fee of 5.44%. The promissory note from the commercial borrower will have a face value of $889,387 and a balloon payment of $879,400 at the conclusion of the project. The annualized interest rate will be 10.45% with a 15.29% annualized yield by including the incentive fee. The debt coverage ratio is currently, in this example, 1.6, which is a very strong debt coverage ratio. This is a very safe investment. Acquire and rehabilitate non-performing notes. Quick access to private capital to acquire first position lien defaulted notes. Deep discounts off face value and off current market value. Our relationship with Smith Syndication provides access to expert power team members to rehabilitate the defaulted note, along with renovating, repositioning, and stabilizing the distressed property. Buying the defaulted note is less expensive and faster than trying to buy the foreclosed real estate owned property or to negotiate a short sale of the property. Controlling the first lien note means controlling the property. We can work with the owner. We can take a deed in lieu of foreclosure or recast the note, including repositioning costs. Sample defaulted note parameters. The property is currently operating with this effective gross income. Subtract this gross operating expense. Net operating income divided by the derived capitalization rate calculates a distressed property value of $1 million. However, the defaulted note has a face value of $1,800,000. The loan-to-value ratio is 180%. The annual interest rate 7%. Amortization period is 360. That's 30 years. And the debt coverage ratio 0.706. This is a negative cash flow situation. We estimate repositioning costs per unit $5,000. We purchase the note for $450,000. Repositioning cost for 30 units is $150,000. The investment to value, the all-in, is $600,000. Now in the rehabilitated note parameters, we've repositioned and stabilized the property with higher gross income, lower operating expenses, higher net operating income. Dividing by the derived capitalization rate, we now have the after repositioning value $1,874,000. We have recast the note. We've modified the face value to $1,312,000. Now the loan-to-value ratio is 70% of the after repositioning value. The annual interest rate is now 5.25%. The amortization period is lower. It's 300 payments. That's 25 years. The debt coverage ratio is a very strong 2.016. The note redemption profit is $712,000. That represents a gross return on investment of 218%. Company overview. Starfury Capital Management LLC is a Colorado limited liability company. Starfury Capital Management focuses on structuring the financing for the acquisition and repositioning of moderately to severely distressed multifamily apartment properties, with the intent to refinance to recover all repositioning financing, both equity and short-term debt, while retaining strong created equity and cash flow margins. Starfury Capital Management is currently focused on finding financing opportunities in deed of trust states in the desert Southwest, the Sand States, of Arizona, mainly the cities of Phoenix and Tucson, and Nevada, mainly the cities of Las Vegas and Henderson, Colorado, near Denver, Boulder, Longmont, Fort Collins, and Colorado Springs, and on the mature oil industry states of Texas, mainly the cities of Dallas and Houston, and Oklahoma, mainly the cities of Tulsa and Oklahoma City. We focus on small to medium-sized properties from about 20 units up to about 50 units. Starfury Capital Management qualifies the borrower power team members for their experience in all aspects of the process, including financial analysis and due diligence, acquisitions, financing, repositioning, asset management, and disposition. Starfury Capital Management qualifies the properties on the market fundamentals, actual and potential cash flow, cost and structure of proposed financing, and the exit strategy for refinancing or sale. Executive Management. Jeffrey D. Smith is the General Manager. Jeffrey D. Smith has over 7 years of experience in real estate financial investment analysis, including over 5 years as a licensed Colorado real estate broker. He has excelled in dozens of real estate law and investment classes and published articles, books, and educational videos on real estate investing. He has authored dozens of sophisticated Excel spreadsheets for real estate analysis and financial modeling. He sells some of his Excel spreadsheets and investment courses to real estate investors. He presents educational real estate investing courses both for online and live seminar formats. He provides private consultation services to wealthy real estate investors. Jeffrey D. Smith is fully trained in all aspects of private commercial mortgage finance. His business acumen and leadership skills provides the expertise for personally negotiating contracts with attorneys and executive management and financial analysis and structure. As General Manager, Jeffrey D. Smith is responsible for vetting the borrower power team of local professional service providers, property sourcing, attorney, real estate broker, private commercial lender, property management, title company, insurance, general construction and renovation contractors, negotiating and structuring the repositioning financing, approving the due diligence, and monitoring the repositioning process. The Radiant Wealth Creation Formula. Investment strategy. Acquire distressed income properties with private financing provided by Starfury Capital Management. Reposition and stabilize for higher income and good quality tenants. Cash out refinancing to redeem the repositioning financing while retaining created equity and net positive cash flow. Acquisition criteria. About 20 to 50 dwelling units in Class B or C distressed apartment buildings. Arizona and Nevada, the Sand States. Colorado, and Oklahoma and Texas, the Oil Patch States. These are deed of trust states that provide non-judicial foreclosure. Mortgage states require judicial foreclosure, which is more time-consuming and more expensive than non-judicial foreclosure. Focused asset management. Cost-effective upgrading and possible merging of adjacent dwelling units to create larger, more spacious units. Community lifestyle with professional asset management. Clean and comfortable dwelling units with good appliances. The investment process cycle. Process cycle overview. We start with an opportunity search. When we find a potential project for financing, we analyze the property, we analyze and qualify the borrower. If this suspect is a prospect, looks like a project that we wish to finance, we then enter negotiation and contract, conduct due diligence in cooperation with the buyer. We then escrow the financing. We escrow closing documents. Once the property is purchased, the owner will reposition and stabilize the property. We will monitor the repositioning. After it's repositioned and stabilized, there's seasoning and refinancing to redeem our repositioning financing. Hypothecated secured first lien note. Starfury Capital Management obtains financing criteria and terms from private financiers by offering yields of 8% to 12% with hypothecated secured first lien notes. Starfury Capital Management reviews lending requests from mortgage broker-dealers who have pre-qualified borrowers and their subject properties according to our criteria. Starfury Capital Management provides, through the mortgage broker-dealer, a lending request to the private financiers who review and approve the financing project. Starfury Capital Management provides, through the mortgage broker-dealer, a terms sheet to the borrower who reviews and approves the loan terms. Starfury Capital Management private financiers' funds are delivered directly to escrow with closing instructions provided by the mortgage broker-dealer. The escrow agent simultaneously closes both transactions. The funding from the private financiers generates a promissory note and a hypothecation agreement, security instrument, from Starfury Capital Management. That is, we are borrowing the money from the private financiers. Starfury Capital Management simultaneously lends the funds at a markup rate to the borrower to generate a promissory note and a deed of trust security agreement. The promissory note and the deed of trust are the collateral of the hypothecation agreement to the private financiers. Starfury Capital Management retains a percentage of the funds as a service fee, retains a percentage of the cash flow from the borrower, and retains a percentage of the final balloon payment. The markup rate covers this retention as a yield spread. The simultaneous escrow closing. We start with Starfury Capital Management SCM as lender. Working through mortgage broker-dealer number 1, we reach terms agreeable with a commercial borrower. We also work with a private lender through mortgage broker-dealer number 2, where we borrow money from a private lender. Mortgage broker-dealer 1 and mortgage broker-dealer 2 then deliver the closing documents to the escrow agent. The escrow agent then performs a closing for mortgage broker-dealer 1, generating paper package number 1, which includes a promissory note number 1 and a deed of trust to be recorded on the title of the subject property. These documents are signed by the commercial borrower. Paper package number 1 is then delivered to Starfury Capital Management as the lender. Simultaneously with this, the escrow agent generates paper package number 2, including promissory note number 2 and hypothecation agreement, signed by Starfury Capital Management as the borrower. Paper package number 2 is then delivered to the private lender. Paper package number 1 is the collateral for paper package number 2. The hypothecation agreement is the security instrument that binds paper package number 1 to paper package number 2. In the event of default on paper package number 2, the hypothecation agreement will convey paper package number 1 to the private lender. In the event of default on paper package number 1, the deed of trust will convey the commercial real property to Starfury Capital Management. Prioritize tranches for debt and equity. There's a first position tranche, which can be debt or senior equity. This is the first to get income from the net operating income and the third in line to pay expenses. The second position tranche is debt or preferred equity. It's the second in line to get income from the net operating income and the second in line to pay expenses. And the third tranche is the common equity. These are the actual property owners. They are third in line to get income from the net operating income and the first in line to be responsible for paying expenses on the property, as well as responsible to pay debt service. Income flows down. Foreclosure survival is top-down. Expense flows up. Foreclosure demise is bottom-up. Second tranche may be debt only when first tranche is debt. Debt only applies to property liens, not participation loans. Structured syndicated financing, participation loans. These can be arranged as prioritized tranches, where the first position lender lends up to 70% investment to value at approximately 8% annualized interest rate. A second position lender brings in the difference of 90% combined investment to value with an annualized interest rate of about 1.5 times lender 1. And then the last lender, the lowest priority, brings in 10% investment to value with an annualized interest rate of 1.5 times lender 2. Or pari passu, equal stance. This is a participation loan where all of the lenders involved have equal standing relative to their contribution. For example, lender 1 could be up to 70% investment to value, approximately 10% annualized interest rate. Lender 2, the difference of 90% combined investment to value, the annualized interest rate is equal to lender 1. And lender 3, about 10% investment to value, annualized interest rate is equal to lender 1. Starfury Capital Management is the syndicator for lender 3 and the leading lender in a participation loan. An LLC holds the note and hypothecation agreement. Participating lenders are members. Syndicator receives a fee at closing, percentage of cash flow, and percentage of balloon. Mortgage pools. Mortgage pools are intended for accredited investors only who understand the risks and rewards of diversifying their investments across multiple properties. Mortgage pools are offered through a private placement memorandum because it is an offer for securities backed by unrelated liens on unrelated multiple parcels of real property. It is not a blanket or cross-collateral mortgage. The investors receive a non-managerial undivided percentage interest in relation to their individual contribution in the entire mortgage pool. The sponsor of the mortgage pool has managerial control of the legal entity. The investors are not holders of the note and security instrument, nor vested in title to the real property. The mortgage pool legal entity holds the note and security instrument, the paper. All of the paper held by the mortgage pool may be hypothecated to all of the investors in accordance with their percentage interest in the mortgage pool. Starfury Capital Management currently has no mortgage pools. Starfury Capital Management currently has no plans to create mortgage pools. Foreclosure and deed in lieu of foreclosure. When a borrower is unable to pay as agreed, we can initiate a non-judicial foreclosure action or negotiate to accept a deed in lieu of foreclosure. When we acquire control of the property, we initiate an aggressive action plan to replace the management and then to repair, renovate, and reposition the property through our relationship with Smith Syndication or other companies that have the required expertise. In some cases, we may seek to sell the promissory note and security instrument to a third party to recover the investment. Or we may offer the property with the existing financing to a qualified borrower who can complete the repositioning project and then refinance or sell it. In the unlikely event that Starfury Capital Management defaults on its promissory note to its private lenders, the hypothecation agreement will convey to the private lenders the promissory note and the deed of trust recorded on the property. The private lenders can then initiate whatever action they choose to recover their investment. Strong protective margins for created equity and cash flow backed by solid commercial real estate provide multiple exit strategies that greatly reduce the risk of loss. Starfury Capital Management works with private financiers. Starfury Capital Management is pleased to offer competitive investment alternatives for sophisticated and accredited investors, especially those who are looking for better yields than stocks, mutual funds, or bonds, and backed by solid commercial real estate with professional management. Starfury Capital Management is executing a tightly focused strategy of financing middle market, that is Class C or Class B, physically or managerially distressed multifamily assets that can be repositioned toward the rapidly growing displaced former homeowners demographic niche market using a community lifestyle approach and providing for new household formation. Starfury Capital Management also buys performing and non-performing notes based upon actual or conservative projections for created equity and cash flow margins. Controlling the first lien note means controlling the property. Buying defaulted notes and modifying the parameters with additional repositioning capital provides significant opportunities for capital gains. We have learned that the Radiant Wealth Creation formula creates excellent opportunity for profit by targeting value-add, underperforming multifamily properties for repositioning them to serve a growing preferred demographic segment. Our private financiers are secured with strong protective equity and cash flow margins. We can manage the risk better because of the predictable outcomes. We can produce consistent investment returns from stable operations. The Radiant Wealth Creation formula increases prosperity for society. If this niche real estate investment strategy appeals to you, then we cordially invite you to contact us to learn how you can be a private financier for these prosperous projects. You can learn more by contacting us. Starfury Capital Management, LLC, Private Trust Deed Investments. My name is Jeffrey D. Smith. I am the General Manager. You can also visit our wealth creation page at www.starfurycapitalmanagement.com. This has been Starfury Capital Management, Private Trust Deed Investing. My name is Jeffrey Smith, and thank you for your support.